Welcome back, ladies and gentlemen, to our video series. My name is Mark Ashegian. I'm a CPA and a partner with the Tax Consultancy Group. We are a CPA firm based in West Los Angeles, California. Today I'd like to cover the income tax provisions for individuals after the President Trump signed the Tax Cuts and Jobs Act of 2018 into law. One of the most important changes under the new tax law is the limitation on the mortgage and home equity interest deduction. Under the new law, you could deduct interest expense on the first $1 million of acquisition indebtedness on your property, and you could also deduct up to $100,000 of home equity. So in other words, interest on the $1 million of home acquisition and $100,000 of the home equity line of credit. However, the new law has limited the entire mortgage deduction to an original acquisition indebtedness of $750,000. So you get to deduct the interest incurred up to a loan amount of $750,000, and they have suspended the deduction for home equity interest. The new tax law has suspended the moving expense deduction, and the student interest loan deduction of a maximum of $2,500 is retained under the new law. Under the medical expense deduction, it used to be that people could get an itemized deduction for unreimbursed medical expenses to the extent that the aggregate medical expenses exceeded 10% of the AGI. For tax years 2017 and 18, itemized deductions for unreimbursed medical expenses to the extent that they exceed 7.5% of the adjusted gross income are deductible. In years after 2018, we go back to the 10% limitation. Under the old law, you could deduct your investment advisory fees, tax return preparation fees, to the extent that they exceeded 2% of adjusted gross income. The new law suspends that. Under the old law, the amount exempt from the alternative minimum tax for 2018 is scheduled to be $55,400 for single individuals and $86,200 for married couples. The new law changes the amount exempt from the alternative minimum tax to $70,300 for single individuals and $109,400 for married couples. The new law eliminates the individual mandate penalty after December 31, 2018. That was the penalty for lack of having essential health coverage, and which would subject you to a penalty. The next change is in the area of alimony. Alimony used to be tax deductible, and the law changed the alimony deduction provision for divorces or separations that are effective after December 31, 2018. Alimony is no longer tax deductible. We have in the accompanying charts other provisions like the kiddie tax, 1031 exchanges, the tax consequences of life settlements, and the changes in the 529 accounts, which I'd like to direct your attention to. With regards to the 529 accounts, use of the 529 qualified tuition distributions are generally restricted for certain eligible educational institutions. The new law expands the 529 plans to permit up to $10,000 in tax-free distributions for public, private, and religious elementary and secondary school. Thank you very much for watching our video series on the 2018 individual tax provisions. We look forward to your questions and we'll be happy to answer them. Please feel free to contact us with any questions. Thank you very much.